interesting topic about director penalty notices. Just a couple of things before we start. Sorry, my name's Stephen Michelle. I'm a director of PCI Partners, for those that don't know me. There's a chat function down the bottom of the screen on this, and we'll take questions at the end, but if you want to put questions in as we go through, feel free to do so, but we'll take all the questions at the end, and hopefully as we go through it, a lot of the questions that you might have might get answered anyway. So today we're joined by Gerald Smith, who is the Assistant Director in Debt Case Leadership, which is part of the Lodge and Pay Management business line at the Australian Taxation Office. Gerald is actually based in the ATO's Adelaide office. The Lodge and Pay Management has a focus on sophisticated clients who are known to have the resources to meet their obligations, including both financial capacity and knowledge of the tax and super systems. Debt Case Leadership is a team of specialists dealing with complex cases and issues and providing expert advice. Gerald's been with the ATO for 40 years and has a wealth of experience across a variety of areas, including client engagement and service delivery. So welcome, Gerald, and thank you for taking the time to share your knowledge in this particular area. I suppose to start with, we're talking about director penalty notices, and there's been a lot of talk certainly in the financial and accounting circles about DPNs. What actually is a DPN?
Thank you, Stephen. Well, I think in order to answer that question, you first need to look at what the director penalty regime is and how it works. So fundamentally, a company director is responsible for ensuring that the company's tax and superannuation obligations are both reported and paid on time. A director becomes personally liable for a penalty. At the end of the day, the company is due to pay its obligation for any unpaid pay-as-you-go withholding tax, net GST, those goods and services tax, wine equalisation tax and luxury car tax. That's from the 1st of April 2020 that kicked in. And their superannuation obligations, and that was from the 30th of June 2012. The penalty is imposed automatically by operation of law. As soon as the company fails to pay the debt by the due date, the penalty arises. And that penalty is equal to the amount that was unpaid, that was outstanding and unpaid on that due date. But Section 269-25 of Schedule 1 to the Taxation Administration Act 1953 states that the Commissioner must issue a notice in writing before commencing proceedings to recover the penalties. And this is what's called a director penalty notice, or DPN. So it's a common misunderstanding that the DPN gives rise to the liability. It doesn't. The director already has the liability as soon as the company fails to pay by the due date. But what the DPN is there for, it's a statutory obligation on the Commissioner to issue one before he can take proceedings to recover. And we recently had, it's not too long ago anyway, that we had advice confirmed that those proceedings include internal proceedings, if you like, really, like offsetting and any recovery action indeed for the director penalties effectively. But the liability is there. It's just the DPN enables us to start recovering it.
Okay, so it'd be fair to say though that most, not all company directors get a DPN when there's outstanding tax. There'll be a
no, they don't. That's true.
No. Yeah. So given that the director becomes liable when the debt's due by the company, and then you've got to issue the actual notice for you then to take action to actually take recovery action. What is the effect of a director penalty notice?
Okay, now it serves two main purposes. One is that the ATO, as I said, the ATO cannot bring recovery proceedings against the director until, in fact, until 21 days after the DPN has been issued. So the DPN actually spells it out. You've got 21 days, and then If you don't take action, then we can start taking recovery action against the director for the penalties. And in limited circumstances, it allows the director to remit their personal liability by taking certain actions within that 21 days. Mind you, they are expected to have tried to take those actions leading up to the DPN as well. So it's not that they have to take those actions within those 21 days, and that's the only time. It goes back further than that. A DPN, from the legislation itself, a DPN sets out what the Commissioner thinks is the unpaid amount of the company's liability under its obligation. So what is the unpaid amount of the PAYG, GST, etc. It states that the recipient is liable to pay the Commissioner by way of penalty an amount equal to that unpaid amount. And it explains the main circumstances in which the penalties can be remitted. So I guess that's in a nutshell what the effect of the DPN is. It's just, as the High Court said quite some time ago now, it's a notice before issue.
Right. Okay.
Yeah.
So you know, the ATO has a number of tools at its disposal to recover outstanding debt. So you know, you can wind up a company, you can issue garnishees. Why would the ATO use a DPN? Why are they generally issued? What's the sort of criteria that you would normally go through?
I guess the main criteria why we would issue a DPN is because the company, it has, well, first of all, the company hasn't paid on time, first and foremost, but they're also not engaging with us in trying to pay the outstanding liability. We usually will try to engage with the company, which is usually through the directors, to pay the liability before. Well, we will attempt to engage before we will issue a DPN. But if we're not getting anywhere in that regard, then really the DPN will then be issued to give us the opportunity, a further opportunity to recover the outstanding liability, but through the directors. They can be issued to a director who has incurred the penalties. And we endeavour to issue it as soon as possible. As you can imagine, you know, there's a lot of director penalties out there, so there can be delays. It's consistent with the primary object of the provisions, which is to induce directors to either cause the company to pay the liabilities or to have the company quickly brought under some form of external administration, so as to protect all creditors, not just the ATO. The Commissioner also recognises that the prompt dispatch of DPNs can encourage directors to address a company's financial responsibilities before they become insurmountable. In practice, a DPN will be issued after an assessment of the risk of the non-recovery of the debt. One very important factor in deciding whether to issue a DPN, as I already mentioned, is the level of engagement in trying to resolve those unpaid liabilities. And it should be noted that the Commissioner will not take action to recover if there is an active payment arrangement with the company. However, the Commissioner can still issue a DPN in those circumstances. So if the company engages such as to put a payment arrangement in place, we won't take action to recover those penalties, but we can still issue the DPN.
So one of the
the sort of factors we take into account, the sort of factors we often take into account with any debt, really, like the size of it, compliance history of the company, the compliance history of the directors will sometimes come into it too as well. And also, we will do our best to look at the capacity and the propensity for payment.
So it'd be fair to say, really, that a key takeaway from today, and it's always been the case anyway, is that you know, communication and early engagement where a business is actually in trouble is probably always the best course of action in terms of trying to solve some of these problems. And sometimes look, that they might not be able to be solved without some sort of formal insolvency being put in place, but at least it probably gives the better option than getting a director penalty notice that makes that ultimately the director becomes, well, personally liable and chased in relation to it. So there are two types of DPNs. So there's a DPN, as I understand it, called a non-lockdown DPN, and there's another one called a lockdown DPN. And I think, when we talk to accountants and directors in particular, there seems to be a little bit of confusion about what they actually are and therefore what options are actually available under each one. So can you just take us through, what the difference between those two are?
For sure, yeah. If the unpaid company liabilities are for PAYGW or GST, and they're reported within 3 months of the due date for reporting it, then the penalties are referred to as non-lockdown, or we call them standard often. If the liabilities are for superannuation guarantee charge and were reported by the due date for lodgement of the SGC statement, that is 1 month and 28 days after the end of the relevant quarter, then the penalties are standard. So that's the main difference between the two types of lockdown DPN, if you like, is the reporting time. You've got 3 months for GST and PAYGW, but the SGC has to actually be reported by the due date for reporting. If the liabilities are not reported within those timeframes, then the penalties are referred to as lockdown. And a non-lockdown or standard DPN is issued for non-lockdown direct penalties, so the ones which were reported within those timeframes. So we issue a standard DPN or not non-lockdown DPN. But if they're not reported within those timeframes, we issue what we call as a lockdown DPN. And the main difference between the two, the fundamental difference, is if it's a standard or non-lockdown DPN, then the directors still have the 21 days to either pay the debt, appoint a voluntary administrator, appoint a small business restructuring practitioner, or appoint a liquidator, that is, begin to wind up the company. Whereas with a lockdown DPN, the only way the penalties can now be remitted is actually to arrange for the debt to be paid. You don't have the option of remitting the penalties by placing the company into administration, liquidation, or appointing a restructuring practitioner.
So if lockdown DPN, you would sort of say they're fairly deadly, I would have.
Yes.
In terms of what a director can do, if, let's say they get one of those, payment arrangement, is that something that...
Yes. They've still got the option of putting the company into a payment arrangement if they can get one accepted. And that will mean that, as I said earlier, that will mean that the commissioner will not take recovery action as long as that payment arrangement is met. Of course, if it defaults, well, that changes things. But and if it's like, I would stress that if it looks likely that it might default, it would be best to contact us beforehand.
Yes, I would agree. With the penalty notices, though, they're sent out generally, well, they're sent out to the director personally, aren't they? Is that how?
Yeah, there's a section which actually states that the commissioner can send issue the director penalty notice to the director's address as per the ASIC record, and that's what we generally rely on. And because the notice is to the director, it is issued to the director at their address, not to the company's registered address. It must be issued to the director because it's for them. It is a notice to them.
So another key takeaway would be that to ensure that for accountants and clients that they ensure that if they change their address, it's notified to ASIC, which they should be
definitely
doing.
Well, they're under an obligation to do that anyway. But yes, this is another reason to do so. Yes,
indeed. So in terms of if a director penalty notice has expired. Sorry, I'll go back and ask another question. Actually, there was something that on the top of my mind before. Single touch payroll. So one of the things that you were talking about was, in fact, where notification of, so they may not be able to, the company might not be able to pay its debts or the tax debt in the particular period. Does single touch payroll have any impact on this at all in terms of notification, or is there special forms that need to be lodged, particularly with super, for example?
Single touch payroll does count as a reporting for the purposes of director penalties. So if the company has reported using STP within the timeframes I referred to earlier, then it will be a non-lockdown director penalty, assuming they don't pay, or standard. If they don't report within those timeframes, even using STP or any other method, any of the standard usual method, I guess, BAS or an SGC statement, then it's a lockdown DPN.
Yeah, understand. Just reminding everybody that there are questions at the end of the session, so use the chat function if you want to ask any questions of Gerald while we've got his expertise here today. So really, in terms of, if we just go through again the options that are available for if a director penalty notice has, say, expired, what should a director do? Okay, so director, we get a lot of these situations where the director and accountant might come to us and they may have had a director penalty notice that's expired, a number of months actually before. The options available at that particular point of time in terms of the director's personal liability, what would you suggest there?
Well, they've now got the penalty and they're not going to be able to get it remitted by placing the company into any form of external administration. So they should try and pay the penalties as soon as they're able to. That's would say that about any debt. And if they're unable to pay it in full, they should definitely contact the ATO and discuss a possible plan to pay it over time. And there's quite a bit of information available on the ATO website about payment options. Director penalties are parallel liabilities. So if an amount is paid by a director towards their liability, or an amount is applied against the liability by, say, an income tax credit being offset against it, then the underlying liability of the company is reduced by that same amount, as is the liabilities of any other director for those periods. And if a director pays a penalty, then they also have rights by way of indemnity, subrogation, contribution, or otherwise against the company and any other directors. So theoretically, they can recover the money from the other directors as well. There are also defences to director penalties. So if they think that they shouldn't have the liability, they should write to us and explain why. But the defences are fairly limited. There are three main defences to director penalties. The first is that for illness or other good reason, the person did not take part in the management of the company and could not reasonably be expected to have taken part. So the second is that the person took all reasonable steps to ensure that the obligation was met, or one of the other three steps was taken, or that there were no reasonable steps that could be taken. And the third one, which really only applies to SGC or assessed net amounts of GST, is that the company treated the relevant act as applying to a matter or identical matters in a particular way that was reasonably arguable and took reasonable care in doing so. We generally tend to think that that's in a situation where the company genuinely was reasonably arguable and they took reasonable care in applying this, what we're now saying were employees they believe were subcontractors.
Right, okay. Understand. Yeah. Yes, that's a more difficult one, I suspect. But
it's a much more difficult one. There's a lot
yes.
of case, as I think you might be aware, there's a lot of case law around whether the difference between employees and contractors. Yeah.
So one of the things that we get approached with, and which is becoming far more mainstream, I suppose, these days, is small business restructures, and there's quite a lot of them actually now being done. So sometimes we get a situation where we'll get approached, and there'll be an expired director penalty notice. And yet the company will be eligible to do a small business restructure. It will satisfy that eligibility criteria. Under the small business restructure, obviously, if it's accepted, there'll be a proposal that's accepted and payments being made, which will come off the tax debt. Can you give us a bit of an idea? Because we get asked, directors received maybe a penalty notice for, I'll just give you an example, maybe a couple $100,000, but the company owes maybe $400,000. The proposal may be for $100,000. How does that $100,000 actually get treated in relation to the director penalty notice, given the parallel process that's involved?
If the $100,000 is all applied, we're all applied against the company's liabilities that was parallel to the director penalties, then the director penalties would be automatically reduced by that same amount. The analogous situation here is, in a way, I guess, is with deeds of company arrangement, and we've often had directors come to us, for example, and say, well, the deed of company arrangement extinguished the company debt, so my director penalty must be also extinguished. There is actually a court decision from many years ago now, I think it was 1986 or thereabouts, and it spells out that, in fact, no, not that far long ago, 2006, what am I saying? That it doesn't, because the law says that the amount has to be paid or applied, I think is the term it uses, against the liability, the director's liability, or the liability, not operated by law. So with a restructuring, if we're talking about the company owing $400,000 and $100,000 it comes to the ATO, it will depend on how that's then allocated. If it's all allocated against the amount that is parallel to the director's liability, then their liability is gone. But if only half of it was, for example, then only half their liability will be gone.
So I know because I asked you this question recently. Where does an accountant go to, or where does an advisor go to actually find out how that parallel or that allocation should work?
There is actually a practice statement which you can find on our website. I can't remember the number offhand, but it's the allocation of payments and credits. It's a 2011 practice statement. That much I do remember, because most of them are for these purposes, and it spells out in quite some detail the Commissioner's allocation policy. So I would suggest going there in the first instance to see how it's likely to be allocated.
Yeah, no, that's good. Thank you. So one last question before we get into the questions from the audience today. And that's what do you see as the ATO's future plans for issuing DPNs? What can we expect? Well,
yeah, as we all know, we've just we're now coming out of a pandemic, and during the height of that pandemic, of course, as everyone would be aware, the ATO backed off a lot from taking any firm action to recover debts. Instead, we worked in favour of providing help and assistance and enhanced engagement. We tried our best to really help people get through those periods, including, as you'd probably be aware, with administering the JobKeeper scheme, which took up a lot of resources. with the lifting of lockdown restrictions, we recommenced our firmer and stronger engagement activities, and that was really what the community would expect for the ATO to start doing that. And we've progressively moved towards a return to business as usual. Most people in the community, I'm sure, would understand that the ATO has an obligation to collect what's owed. While we focused on reducing collectible debt, we're still committed to engaging with small business and offering tailored support and assistance to people with overdue payments. We are here to assist. Yeah, it's an old story, isn't it? The government, I'm from the government, I'm here to help, but yeah. And the ATO was willing to find solutions for hard-hit businesses that are willing to engage. Where clients are disengaged, we must take enforcement action, and that will and can and will include DPNs. In March and October of 2022, we issued more than 52,000 awareness letters to directors of companies whose company had not met its debt obligations, which advised that we were considering issuing DPNs. For those taxpayers who didn't respond to the letter and aren't engaging with us, we have escalated our actions. So it's really, again, it's coming down to, if you don't engage with us, you're likely to get one of these things if you are a director and the company has outstanding obligations. But if you do engage, particularly if you can put in place a payment arrangement, you may still get a DPN, but we're not going to take any recovery action as long as you stick to it.
So again, that key takeaway is early communication with the ATO.
Yep.
Absolutely.
Always.
So I think we're getting, there's a couple of questions here. So the very first one, this is an interesting one. Can the assets of a spouse be subject to sale to recover funds necessary to pay directors' personal liability?
Only if the person were bankrupted, and then it would be through the bankruptcy, the action of the bankruptcy trustee. Not we haven't got any direct power ourselves in the ATO to do that.
So I suppose that's right. So really the next step from, let's say, the director penalty, the company goes into liquidation or whatever and doesn't pay the debt, or there's a director penalty notice that's issued. Really your next step from the director penalty notice is what, bankruptcy proceedings, is that right? If the person continues to, if the director continues to fail to engage with us, then we can turn to all our usual forms of enforcement, of a firmer recovery action, I should say, such as issuing garnishees to the director for their personal liability, but also ultimately, yes, a summons, getting judgment, and if necessary, bankruptcy down the track. Yeah. Okay. Yeah, no problems. And that's right. So, and it's really only at that stage that, so you can't come in and, yeah, the garnishee might be a little bit different in terms of what you garnishee. So what would you garnishee bank accounts generally? Is that what we're talking about? Bank accounts are the usual, well, not usual, the most dominant form of garnishees, simply because it's the easiest in many ways. But we can at times garnishee by other means. I mean, we do garnishee proceeds of sale from property, for example, but it's a lot less common. Okay. Next question is, by STP lodgement of PAYG withholding and superannuation still makes the DPN a soft notice, even though BAS IAS, not the SGC, is not lodged with the ATO. Yeah. STP is considered to be an adequate reporting for these purposes. Yes. Okay. Yeah. So, which is interesting. Actually, I didn't realise that. Is it still the 90-day period applied to STP lodgement? Yes. Yeah. The reporting has to be within either the 90 days, if it's, or it's actually states 3 months, not 90 days, but if it's PAYGW or GST, but by the due date itself, if it's SGC.
I should just clarify one thing on the STP front, and that is if the STP does not report the entire amount, then there will still any amount not reported will still give rise to a penalty that can be locked down under those circumstances. So, for example, if the amount of SGC owing was actually $60,000, but STP reported $50,000, then the $10,000 could still be a lockdown penalty.
So would you, in that case, would you still recommend then that obviously the normal lodgement that would normally be made is actually made?
Yes. It's always best to do that if you can. Yeah.
I don't think there's really too many other questions. Just one more thing. So the director penalty notice applies from the date of the 21 days runs from the date of issuing the notice. Is that correct?
Yes. Yeah. According to the provisions of the Taxation Administration Act, it says that the date of issue is the date of service, effectively.
Yeah. Even though it may go out to to Australia Post and
it does. We send through Australia Post, and but there is a provision there that just says that is the case. And service is considered to be on the date it's issued.
Yeah. Okay, that's good. Chris, is there any questions from you?
I've just got one question. I believe it's possible to issue a director penalty notice post liquidation, although I gather it's reasonably uncommon. Could you perhaps comment on that, please?
Yeah, we could only issue a DPN post liquidation if it's for lockdown penalties, because the liquidation otherwise will have automatically remitted the penalties.
Right.
But if it is a lockdown penalty, if they are lockdown penalties, we could issue a DPN well after liquidation, and often will. And this can cause problems, of course, because the director may have trouble getting hold of records that are now with the liquidator, and things like that. But nevertheless, we certainly can and will.
I haven't seen it very often myself, but I have seen that happen.
Yeah.
Yeah. The other question I've been asked a couple of times is, and you've mentioned PAYG and so on, and GST, but someone has asked me a couple of times on questions whether company income tax is liable to a DPN. No. Just wanted
it's only the three taxes that are specifically referred to in the legislation. So that's
that was my understanding.
Yeah.
Thank you.
Okay. So look, if there's no other questions, Gerald, thank you very much for sharing the time with us today and sharing your knowledge. It's a very interesting area and very topical at the moment. So we appreciate you actually spending the time with us this afternoon. Thank you for all that have attended today, and thank you for again supporting the Red and the Black series. And we look forward to presenting our next topic to you very soon. So have a good afternoon, everybody.
Thank you very much.
Bye.